Saudi Arabia is no different than other countries in terms of the opportunities that it had over the past few years in private equity. As Hisham was saying earlier, we had issues, although in execution, and that's why probably the number of transactions in private equity within Saudi Arabia is less than those were executed in neighboring countries in GCC or in North Africa. That's mainly due to difficulties in execution, whether on a legal framework, availability of information, difficulty of due diligence within Saudi. At the same time, we had probably a bit more attractive transactions at the time, or easier to execute in other countries. Now the picture is changing with the financial crisis, and Saudi is becoming more and more attractive for a lot of private equity investors to invest within the country. Obviously, the opportunities lay in private sector. We're talking about a growing country. The capital market is very healthy. It's a highly liquid market. As Hisham mentioned earlier, again, there's a large number of funds that were raised for mainly MENA region to be deployed within the MENA region within private equity. And if you look at the private equity map today, there are very few countries that can actually execute, and Saudi is one of those countries. So the availability of liquidity on one hand, and the availability of deal flow within Saudi makes it a very healthy formula. In addition to growing businesses, there is also the privatization of a lot of sectors that government is going through. And that privatization creates, again, large opportunities for a lot of private equity investors that are looking at specifically that asset class. So overall, the overall picture for private equity investors within Saudi looks very attractive, at least for the next, I would say, 5 to 10 years.
Thank you.
Starting with Saudi, and probably that applies to a lot of neighboring countries within GCC. We're growing population, so the obvious ones would be healthcare, education, consumables, so things related to manufacturing maybe. We've seen a lot of transactions floating on oil and gas services. Oil and gas services generally within Saudi is fairly old. It all started in the 60s and 70s, and a lot of them are due for refurbishment now. We've seen initiative of Saudi Aramco, for example, of localizing some of their suppliers, and that created a lot, again, good opportunities for some of the private equity investors. And I mentioned earlier the privatizations. We've seen a lot of, so far we've seen 5, I think, IWPPs. That's only on the power side. We've seen privatization on the aviation side, on Saudi Airlines, 2 of their business lines so far. The mining, again, that's a good sector for private equity investors, and it's ongoing in privatization manner. The government of Saudi Arabia has announced probably a few years ago, I don't remember exactly, around 10 to 11 sectors to be privatized, and that again creates a large opportunity for a lot of private equity investors. And again, when we're talking about private equity investors, we're talking about, generally private equity investors, because some of them, they look at different asset classes within private equity, longer term, such as privatization and mega projects investments, and some look at smaller transaction with higher returns. I guess beyond that, retail, hospitality, maybe more, and again in Saudi, and real estate is a very attractive sectors within Saudi. Within GCC, I guess again a lot of these sectors do apply And we've seen some transactions in GCC within those sectors. We've seen a lot of manufacturing transactions in Egypt, for example, and in Jordan. Power and privatization, again, we've seen some in North Africa, in Morocco and Algeria. So there are quite a few sectors that would be attractive for different type of private equity investors. Well, obviously, again, it all depends on the transaction and the timing and all of that. But a lot of exits has been through either a strategic sale to another investor or somebody who's in the business. We haven't seen a lot of IPOs, unfortunately, going from private equity, and again, I think that's where the question wants to lead. It has to do with mainly the size of these transactions and how much they're ready to be floated. A lot of transactions that happened within private equity, within Saudi at least, were smaller to be floated. Again, some of these transactions happen in partnerships with owning family that's managing these businesses, and a lot of the private equity investors were either a minority or at best a significant minority. So it was difficult to structure an IPO out of these transactions. Obviously, there will be always exceptions. The capital market, I believe, is ready for exits on the IPO. It's a matter of timing in terms of selecting the right time to be on the market. We've seen a lot of exits that happened so far, going from one private equity investor to another. Again, that's all driven by how much liquidity is available for private equity and how much pressure the private equity managers, asset managers, are under to deploy their capital. In some cases, they end up, you see, same asset going from one investor to the other. I think obviously the opportunities are huge in sub-Saharan Africa, but I think the challenge would be, and as Hisham mentioned earlier, is understanding the risks associated with executing a transaction in any region. More importantly for private equity investors, because they'll be involved in the business, so they need to know the legal framework. Whether on the structuring side or even whether on the exits, for example, as mentioned by Benjamin, or generally running the business, all the risks associated with making a private equity investment from sourcing a transaction all the way through the exit. So I think that would be the challenge for a lot of non-African investors, whether Saudis or GCC or regional investors. So I think the challenge in the execution, not in the opportunities. I guess in short, it has been a challenge, not only in البلاد investment company, but in a lot of investment banks that are Sharia compliant. And I guess the challenge is not convincing the Sharia board, because I think that the principles are there and they're set, and there's no variables there. The issue has been, and I think will continue to be, is explaining or simplifying those financial structures or the instruments or the product or whatever that might be to the Sharia, to non-financial, really. That's what we're doing. We're explaining a very complex investment product or financial structure to a non-financial person. If we could achieve that, I think that will bridge the gap. In البلاد investment company, where we have been successful in bridging that gap, we're actually allocating a specific team, if you like, that will be sort of intermediary between the business and the Sharia board. And the job of that team is to explain, understand the product first of all, or the issue financially, and simplify it and explain it to the non-Sharia scholars on the other side. And it was mentioned, I think, here yesterday that a lot of rejections or differences between Sharia boards within banks, or sometimes within the same bank on the same product, it's not because of the variables of the Sharia principles, but it's because of the understanding of these products. So I think the understanding is a key issue here. If you achieve that, there shouldn't be any gap. Yeah. I think the short answer is yes, in a lot of sectors. Obviously, the key difference between direct investment, whether family offices or others, and private equity is the structure of the deal, the involvement of the manager, or the investment manager, and the exits. Historically, there were two different businesses altogether. Sometimes they overlap in some sectors. It has to do with the strategic focus of the family office. Sometimes it overlaps with some of the focus sectors of the private equity. And I think more recently we've seen a lot of family offices acting as private equity investors. Mainly, I don't know the reason exactly. I mean, this is a development of probably a number of reasons. It has to do with availability of funds, knowledge of the market, availability of deal flow, and sometimes strategically just investing within their backyard sort of thing, whether the same sector, same space, or just simply the same country.